Good evening, everyone. Thank you so much for joining in the session. We'll start the session in a couple of minutes. We're waiting for everyone else to join. Thank you so much for your patience. Hello, good evening, everyone. Thank you for joining us for today's webinar. I am Simran and I work with Tally Solutions for the Middle East region, and I will be your host for today. As you all know, we are just a few days away from the implementation of UAE corporate tax, which has been one of the biggest news after VAT. Corporate tax on business profits will be applicable from the 1st of June 2023, and most businesses will become subject to the UAE corporate tax. In the recent past few days, the ministry has announced some new clarifications around this new compliance norm, and today we will be talking all about it along with the adoption of transfer pricing during this webinar. Just some ground rules before we get started to ensure a flawless experience. All the participants will remain on mute throughout the session to avoid any noises and disturbances. Please be informed that we are recording the session and it will be available later. I apologize in advance for any network interruptions that may occur. However, we will try our best to make this experience seamless. I'm sure you would have questions during this discussion. Please type them in the question box of your Zoom control panel and we'll bring them up towards the end. Today, we have two eminent personalities with us who have got profound knowledge about this topic, and let me invite and introduce them. First, we have CA Akshay Kenkre, who is a tax advisor and a fellow chartered accountant by profession, who is well known for his expertise in transfer pricing and international taxation. He is the founding member of the TransPrice group and currently leads the practice where he advises the finest multinationals on global tax and transfer pricing structures. He has been instrumental in curating winning tax strategies for his international clients. As an entrepreneur with work experience at Big Fours and leading business houses, Akshay understands the technicalities involved in the subject of taxes and transfer pricing, along with the practical application of complex tax solutions to dynamic industry scenarios. Next, let me introduce CA Ashna with us, who is a practicing chartered accountant with almost 2 decades of experience in finance and administration in the UAE. Ashna is a well-reputed tax consultant in the UAE and is well acquainted with auditing, company formation, taxation, and accounting. She has been associated with several high-profile mergers and acquisitions and has played a crucial role in setting up the finance and administration departments of organizations. Her clientele includes businesses from diverse industries, including manufacturing, pharmaceuticals, real estate, advertising, IT, and technology, food, restaurants, etc. An ex-banker, Ashna is actively associated with several platforms for knowledge sharing. She enjoys working with young students and mentoring them in finance and accounting related matters, also is part of the university's mentorship program. Over to you, CA Akshay and CA Ashna.
Thank you, Simran, for a very kind introduction. Yeah, I think this topic is of a great importance, and I think the testimony is around 71 participants on a Monday afternoon, Dubai or evening India time. So we'll jump directly into the topic, but just before that, a quick introduction about TransPrice Tax. We are a tax firm focused mainly on transfer pricing, taxes, and international tax, present now in India and UAE both, and have network partners all across 60 countries through Pantera Global. Just to quickly set on the context for today, we are going to mainly talk about the corporate tax in general, the updates on corporate tax, as well as practical inroads into transfer pricing for many multinational companies and also small and medium enterprises. So Ashna will mainly give a background around corporate taxes for all of us, and I will then dive deep into the transfer pricing journey for all of you. So this presentation will be there for around 45 to 50 minutes, and we have the last 10 minutes for question and answer round for sure. And you can post your questions in the question and answer box of this Zoom chat. So with this quick introduction, over to Ashna on something around basics of UAE corporate tax and its relevance around transfer pricing.
Thank you, Akshay, and thank you everybody for joining at this odd hours and during the office time. As we all know by now, what is corporate tax and why it is introduced in UAE. Corporate tax is basically a direct tax on your net profits. It is going to go out from the net profits, so it is going to be an additional burden to the businesses in UAE. So it's very important now to start focusing on how to maintain your books, how to streamline them, what are the chart of accounts. These are the factors that are going to drive your net profitability. No more we can say that UAE is a tax-free country. We ideally have just 2 more days left for it. And from 1st of June, the CT law will come into picture. So in VAT, what was happening was it was a consumption-based tax, but as we all know that corporate tax is not consumption-based, it is going to be on your net profit. So unless you understand what is the corporate tax base, the net profit base, how to arrive at your net profits, and then the rate of 9% applies. So the importance here again goes back to maintaining your books properly.
So the way I see it is corporate tax essentially is a cost of doing business. Yes. And any cost of doing business needs effective management. So it's very important that most of the SMEs and MNEs focus on this particular cost and which they are going to incur and manage it effectively.
True. Now to understand who is going to be taxed in UAE is most important, because all the provisions are run across this definition as taxable person. In taxable person also, you need to understand who are resident, who are non-resident. Natural person will come under it or not, because the reliefs that are being given, whether it is SME relief, it is only being given specifically to a resident taxable person. So for that, first you need to understand from the taxable person's definition who comes under the purview of corporate tax purview. The taxable person is a legal person. Now, what is the meaning of a legal person is you need to hold a license entity in UAE, whether it is mainland, free zone, that really doesn't matter. Everybody who holds a license in UAE will come under the CT purview of the law. There is another category which comes in, which is a natural person. Now, natural persons in UAE does business through either sole establishments or they are partners in the unincorporated entities through related party, connected party, wherein we need to understand what is their relation and are they doing business activity or not. This term is extremely important when it comes to natural person. Are they doing business activity, or it is being earned by them through their through the revenue which is earned by them is through wages, salary, which is not in the nature of business activity. So the first base of understanding corporate tax would be here is whether which part of the taxable person definition do we fall into. So any company which is legally incorporated or not, are you a resident or a non-resident? Does the company, next slide, Akshay. See, in this we can understand if you are a resident or a non-resident. If you are a resident, it is pretty simple. You need to have a license and your main source of business is in UAE. But if you are a non-resident, how will CT apply to you when you are a non-resident? Whether you have a permanent establishment in UAE or you do not have a permanent establishment in UAE. Whether the management is sitting in UAE, as we understand, most of the companies here, the management is staying in UAE for a better lifestyle. The company may not be formed in UAE, or it can be also the other way around, where they have a agent here running in the UAE. Then what happens to these nature of income is extremely important to understand. So again, the core of a permanent establishment and home, these concepts come into picture here. What are your thoughts on this, Akshay?
Rather than thoughts, I think a lot of experience on the PE side and also POEM side. So although these concepts are quite opposite to each other, the way they impact any taxable economy, the ramifications could be very widespread. So if you are a PE of a foreign company in that particular country, that you are taxable in that particular jurisdiction, so you need to carve out a separate books of accounts. Sometimes it is quite difficult to maintain a separate books of account and also to derive profits onto that, or to artificially attribute profit to your permanent establishment. So there are n number of difficulties when a PE is established if there is no fiscal discipline or financial discipline when a PE is being thought through. On the second hand, there is a place of effective management, which is more of a residency test in most of the tax jurisdictions, which has the potential to pull in a non-resident company or an enterprise as a resident in a company or in a country. So in this case, let's say it's UAE, because the management and the decision making is happening in the UAE. So although PE talks of attribution of profits from non-residents, a POEN concept basically talks of making a non-resident a resident. So both as such are provisions with extremely wide ramifications and need to be looked into by companies very thoroughly and thought through in terms of placing any model. And of course, transfer pricing on top of that will play a very, very important role. Either you are a PE or you are falling under the POEM rules.
Yeah. Moving ahead, the tax rates Why have I put this slide is, by now we all know there are two tax slabs, 0%, 9%. But if you are an individual and a taxable, juridical taxable person, then up to 375 net profit would be at 0%. Above that is 9%. But the most important thing here to understand is qualifying free zone person. Do you want to opt as a qualifying free zone person? And if you opt for it, then what are the criteria for opting for it, and what are the advantages or disadvantages of opting for it is also what a company will have to assess. So what does this qualifying free zone does? It qualifying free zone, your rate of tax will be 0%. So, but what are the criteria on basis of which you can opt as a qualifying free zone? The first important criteria is you have to maintain adequate substance in the state. Now, adequate substance in the state is at the moment debatable. Whether, suppose a company example is formed in DMCC free zone, or say DWC, Sham, there are like 44 free zones in UAE. How would you prove that you are substance is only in that particular free zone? Maybe your employees are working from Dubai mainland, which whether it is only UAE or it is only pertaining to that particular free zone. And once you work outside that free zone, are you breaking the free zone regulations or not? That clarification ideally should come by tomorrow, day after tomorrow is what we're expecting, because there are only 2 days left. Then you have to also understand what is qualifying income, because all these rates will be based on qualifying income. So qualifying income, which is earned within the free zone, is also important to understand. Here, the companies ideally will have to maintain segment-wise reporting. So even though it's one company, books will have to be maintained segment-wise for better understanding and for the compliance purposes also. Not that the government has asked you to maintain, but I would prefer that it's a better option once your books are very clear and you have segments like free zone related revenue or mainland related revenue or rest of the world. If you have segments within your books itself, it is very clear and there won't be any confusion. The most important part here is this qualifying free zone will have to comply to all the transactions which they are doing to their related and connected party will have to be TP compliant. Now, how they have to be TP compliant and what are these TP rules at arm's length? See, most of the times we always say, let's keep the relatives at arm's length. And I think in real world, TP also in a tax world also, this transaction has to be at arm's length. So whether it is life or it is TP, relatives have to be kept at arm's length. So what are your thoughts on this, Akshay? I mean, can you take us through what are the TP related aspects when it comes to qualifying free zones?
So I think it was around 13th or 14th of May when the transfer pricing documentation thresholds were prescribed. And I think when the 200 million threshold was prescribed, most of the organizations have somewhere assumed, because I've spoken to many, that transfer pricing won't apply to them. However, that's not the fact, because transfer pricing is going to be very different in UAE as compared to other countries. Because let's talk of India. Okay, India wants to protect its own tax base, and that's why there should not be any profit shifting happening outside India. However, the story is little different in Dubai or UAE. It's more about, because everybody would want to keep profits in the UAE with the low rate of tax of 9%. It's quite competitive. However, there are two separate jurisdictions of taxes in one country, which is a qualifying free zone and a mainland or the 9% regime. Any transactions between these two regimes could have a potential, you can say, threat in terms of eroding the tax base from mainland to free zone. And that's why the TP documentation limit of 200 million, whether it applies even to qualified free zone or not, that's a big question. But the way how I read the law, it's more likely than not that this particular limit doesn't apply to qualifying free zones. And qualifying free zones still will have to maintain TP documentation under Article 55 and also do an arm's length testing under Article 34. These two are separate concepts. And if I try to just correlate to our health records, documentation is like compelling us to keep our health records for insurance purposes. However, because I need to not maintain health record, that doesn't mean that I don't take care of my health. I still will maybe take vitamins. I'll still try to get well soon. So that's more about arm's length concept. So you still need to be arm's length, even if you are not doing any transfer pricing documentation. So Article 34 and Article 55, two separate aspects together. Even if Article 55 doesn't apply to free zones below a certain threshold, it's very important to comply with Article 34 and maintain an arm's length relation with the mainland and other related parties. Over to you, Asha.
Yeah, one more thing is when they say TP documentation is such a certain threshold, they haven't said that they are not going to ask. They said that documentation can be asked by the ministry at any time. So it's not that you're not expected to maintain it, because they can ask any document at any time. So it's always better to be compliant from the start rather than, yes, you may not have to file it along with your returns, but that does not mean that the ministries cannot ask for it. Ministry can ask for these documents. Yeah.
And I think that cabinet decision is mainly talking of 3-tier documentation: a local file, a master file, and CDCR. So a local file in all sense is still required to prove that you are doing transactions at arm's length. So that's very, very, very needed. You may not need to maintain an elaborate documentation in the way how it is mentioned, but at least certain document to prove is very essential.
True.
So with this, Ashna, I think it was a good background to set to introduce transfer pricing as a concept to the audience. So Ashna, would you like to just quickly take this slide up?
Yeah, so what is transfer pricing? Transfer pricing, the name itself is very clear. It is a particular price at which, the related, when there is a transaction between two parties, which is related to each other or connected to each other, any transaction that happens between these two parties will have to be at a certain price. In UAE, this concept was never there because taxes were never there. But now, any transaction which happens and they have said that 4 level of kinship, they haven't said there is a proper definition for it, what is related and connected party. So if a company sits, suppose in UAE mainland and there's another company in the free zone, and if these people are selling goods to each other and the management is common or the owners or partners are common, then how will you price your products is where transfer pricing would come into picture.
Yeah. So predominantly an anti-avoidance law. I think UAE also now has a general anti-abuse provisions. So transfer pricing as such becomes a special anti-avoidance law, which typically looks at prices, which results into control over profitability, and any exchange of goods and services between two related parties need monitoring for an effective tax regime. So this is mainly the, I would say, brain and heart for any taxes. Because if you are able to control profitability and if there was no transfer pricing, any tax law will fail. And frankly, that really happened when India opened up in 1991. Up till 2000, it took almost 9-10 years for India to also realize that once you open up the economy in 1991, there is a law like transfer pricing, which is very essential to have appropriate profit so that there is no tax avoidance which is happening. Going on to the next slide, why transfer pricing is important? Because there are 3 main concepts in taxes. Either you do a tax planning, I will add it to aggressive tax planning also, or there could be means and mechanisms to do tax avoidance. Tax avoidance is where you are legally absolutely fine, but when it talks about commercial substance, it lacks commercial substance. And that's why in the qualifying free zone definition also, the first condition is maintaining substance in that particular jurisdiction or in the state. So if you don't want to get caught in the tax avoidance bracket under GAR or under transfer pricing as a law, then it's extremely important to plan your taxes and fall in tax planning as a pillar rather than tax avoidance. And I will not really come to tax evasion because evasion is completely disregarded regarding the tax law and doing complete opposite of what it is meant to be. So if you talk of UAE transfer pricing in a nutshell, or any country's transfer pricing in a nutshell, it actually consists of these provisions. A transfer pricing regulation from a theory perspective is quite limited. It's all about practicals. It's all about business and dynamics. So there's a market value or maybe a fair market value that is generally defined. Then you have an arm's length principle, which actually means a fair market value derived through certain methodologies. That's what an arm's length principle is in third-party scenarios. We'll cover that in this presentation. Further, transfer pricing has certain methods through which an arm's length price needs to be derived. And these methods are globally very, very consistent. They are globally accepted methods. So UAE has also followed a 5+1 method formula, which we'll again cover in this particular presentation. Then we have something called as an arm's length range. Because it would have been very funny to only give one particular percentage, like you should be maintaining 10% or you should be maintaining 17%, because businesses don't work like that. There can be 18% in some year, there can be 14% in some year as far as net profit to sales ratio is concerned. And that's why it's very important to have an arm's length range where you could fit in that particular range and consider yourself as being comparable with given third parties. Then there is a definition around related party and control. In general parlance, this is also called as associated enterprises in OECD terminology. UAE has retained related party as a terminology in their English version. Then you have a concept of transfer pricing adjustments. So there are two types of adjustments. Either you do economic adjustments onto your prices to come to the right arm's length price, or if you're not coming to the right arm's length price, you do certain adjustments in a way where you pay either higher taxes self suo moto or through self, or the tax authorities undertake certain adjustments. So transfer pricing adjustments could be either economic adjustments so that you can compare with arm's length price, or these are adjustments which is undertaken to profits so that you pay a higher amount of taxability. Then there is a concept of connected person. Now, these are certain persons which are close enough to influence the management and close enough to influence the business. Any payments made to them would also need to be considered at arm's length price and hence covered under transfer pricing regime. This concept is also there in India. However, transfer pricing doesn't directly apply to connected person until unless certain conditions are fulfilled. Then you have corresponding adjustments as a concept, which talks about if there is an adjustment undertaken, say, in one country, say US, a corresponding adjustment is given by the other country, because transfer pricing is always going to be a two-sided economic analysis. It can never be a one-sided economic analysis. And hence, this plays a very important role in the strategic management. If we are not able to control our transfer prices well, and if there are going to be adjustments at either of these sides, then that will directly result into double taxation. So transfer pricing has the potential to directly impact your profitability through double taxes. I have seen cases where you have earned profits as 100 and you have given profits out entirely in taxes and interest and penalties as 100. So transfer pricing has a potential to completely erode your profits and convert that into taxes itself. So we need to be very careful when we are trying to apply transfer pricing in the tax scenario. And last but not the least, there is transfer pricing documentation against which there are thresholds which are prescribed. And I'll go more through the details as we progress.
Yeah, one thing, Akshay, in this market, right, we have seen like there are connected individuals, connected parties who are in both the companies. Suppose there are related party companies and there are individuals who are providing advice, or they are in the management position. how do we benchmark such transactions is what most of the time the worry is
No, it's
around
a
this market is. How do we benchmark these individually connected party transactions?
yeah, it's a tough question to answer, but there are methodologies. There are all method to madness. So India also brought in specified domestic transactions and included connected parties few years ago in transfer pricing. Lot of issues on this because when you have individuals and these are individuals who are directors and these payments need to be then benchmarked, then you have to essentially compare those with other directors. And no director or a management person would be happy to get himself or herself compared with other directors because there will always be differences, which results into dissatisfaction and which leads to a lot of subjectivity when the tax authorities are questioning. So there are methods like either we do a direct comparison or then we do a net profit based comparison, or then we ask them about the value addition that they are doing and look at the value added comparison. But these are all very subjective, very difficult. And somewhere it goes towards the valuation rule, where many a time people say it's all khayali pulao, as we call it, to benchmark connected persons. But yes, there is a method to benchmark. It's going to be difficult. It's going to be subjective, but there is a method, uh, and there are enough resources available there. Uh, but it's all about implementation, the way you have to implement it, Ashna.
Yeah.
So in India, there is no more connected persons being put under transfer pricing. They have pulled it off. But still, under taxes, we need to prove it. So essential way of adopting transfer pricing in any company is to identify a related party, first of all. So Ashna, as you mentioned, there is a fourth degree of kinship from an individual perspective that needs to be looked into. And we need to see if there are any transactions between the companies of the fourth degree of kinship and also amongst the individuals if there are businesses being undertaken. The next important point, which is very consistent even with OECD, is UAE is talking of scenario where the shareholding, either direct or indirect, is more than 50%. It's more of a parent subsidiary relationship. Then there is a direct or indirect control. However, there is an added complexity of a significant influence, which means that if your shareholding is or maybe below 50%, however, if there is a significant influence on the other related party, then such two parties will become a related party, although in percentage terms and mathematical terms they are not. And they have also gone ahead to define what this particular control means. It means if you have more than, say, a right of 50% in the voting, or if you have right of 50% or more on the board of directors, or on the profitability, or you have ability to determine or exercise significant influence over the conduct of business. Now, this is again very subjective. If I'm holding a 20% in other company, but I am essentially taking all the decisions of the other company, then in such a case, as per this law, the company where I hold 20% and myself will become a related party because there is a significant influence. Now, how you are going to basically implement this significant influence and how you are going to find this significant influence, because business dealings are not as simple as the law is. They are complex. And the person who is holding 80% will never agree that the 20% person is actually having a significant influence over me. So these are dynamics in the business, and that's why I said transfer pricing is more practice than law. And these are all practical instances. We need to go through the agreements. We need to look at the management discussions to find out whether there is significant influence or not. Let's go and try to understand how to identify a related party. Now, these are only few pointers that I have put in. There is no scientific method in finding a related party. However, I somewhere feel that if you go through this particular matrix, most of the related party of a particular company could have been identified. So the first point is internal controls and procedures. So as an accountant or as a management, we should always look at what are the internal controls, either automated or manual, which are implemented by the management to see and find out related parties. Are they tagged separately in your accounting software? That could be one of the criteria. Then how they are getting clubbed into a related party transaction schedule, or are there any other identification parts? So tagging is very important in their ERPs or accounting system to find out. So that's all about internal control and procedures. The other way we could look at is simple management discussions, because transfer pricing as a law includes a lot of discussions with the management. A detailed interview with top management can really open up a lot of related parties, which in ideal scenario or in system may not be even appearing. So that's the second level. The third part is your MIS systems, your financial statements, how they are representing related parties in general. So that could be a good area to find out your related parties. The best way to look at percentage-based related parties is the list of shareholders if you have. So once you go through the list of shareholders, then you go back to your internal controls, then you go to your financial statements, and that's how you can identify your related parties. Identification of related parties and undertaking a transaction with related parties are two separate things. Until unless you identify a related party, you will not be able to identify the transaction with the related party. So there is a high possibility that there is no transaction with the related party, but it's essential that you identify that related party and keep it on records. And last but not the least are the contract reviews. So if you can go through the contracts where there possibly could be no shareholding at all, but the sales or the purchase through the contract terms are completely influenced and dominated by a third party. In such a case, even the third party could become a related party, even if it is not holding even a single percentage in a particular company. It's quite widely defined from a UAE perspective. Let me tell you that. My Indian experience is related party is defined elaborately and narrowly. However, from a UAE perspective, it's quite wide and it could be open to interpretations. So these could be various ways to identify related party in general. Let's move on to arm's length principle. Now, again, the arm's length price or arm's length principle, it is consistent with the global arm's length principle altogether. And arm's length principle is ideally a fair market value. So, frankly, if you talk of English, arm's length price and fair market value ideally should be the same. But transfer pricing guys like it to be complex. And that's why they have coined this new term called as arm's length price. But yet there is a difference, because every time a fair market value should not or could not be in relation with conditions, but a arm's length price is specifically determined as such a price in uncontrolled conditions with independent parties. Even if the parties are independent, but the conditions are controlled, then the price or the arm's length price or your third party price is not your arm's length price. So every time you are determining your arm's length principle or arm's length price, the price should be a fair market value in an uncontrolled condition and between independent parties. So that's the crux which I have underlined here. What's the difference between ALP and FMP? Important for us to understand on a practical basis. Determining arm's length price has 5 methods prescribed plus a 1 method prescribed, whereas fair market value, there is no method prescribed. Even a normal quote given in a third party scenario could act as a fair market value. However, a quotation doesn't act as a fair market or arm's length price in a transfer pricing scenario. There are no documentation requirement for determining fair market value. However, there are significant documentation requirement when you're determining an arm's length price. Comparable circumstances in uncontrolled environment are extremely important to determine arm's length price, which are not necessary in fair market value. And the actual conduct of a transaction is essential to calculate arm's length price. However, conduct is not really. So what you're actually dealing into or your business is there is no such requirement under a fair market value. So these two concepts from a TP point of view are separate, and both these concepts somewhere appear in the law in general. Now let me take you through an ideal journey of transfer pricing, and there are 9 boxes here. Out of these 9 boxes, if you see the squared box, that's basically a box which ideally you need to do it before you enter into any transaction. And what is post is after you have closed your financial statements and you are testing these transactions. The way you generally go through any transfer pricing journey is, first of all, you need to detail out your entire objective of the group, which means how your group looks at your global business and how your group is looking at global taxes. Is it more UAE driven group? Is it more UK driven group with a UAE distribution hub? Who is the entrepreneur in the group? Where the managements are sitting. So all those objectives need to be very clear to you when you are going to start a transfer pricing journey. Most of this happens through a discussion and management interaction. Once you do that, you identify your related parties and you build your entire transaction map in a way that all your transactions with the related parties are effectively mapped up. Once that is done, you really look and carve out an effective global structure. Your global structure could either be your holding global structure or your operational global structure. Holding structure is the way how you are held through various levels of subsidiary and parent level companies, and your operation structure is the supply chain or the value chain through which you are doing businesses. Once you do that, detail out your value chain and supply chain in line with the functions that are discussed with the management. It's getting a little bit complex here, but this is something which is very essential in transfer pricing before you enter into any transaction. Post that, you undertake your benchmarking studies and enter into intercorporate agreements. Now, these benchmarking studies are undertaken on third-party databases, and intercorporate agreements are basically agreements between two related parties. And these are not legal agreements; these are more commercial agreements. So this has more commercial flavor and not so much legal flavor, because ultimately these will be looked in by the tax authorities and never challenged in the court of law. So there has to be a lot of practicality, lot of fluidness, and a lot of clarity in terms of functions when you are looking at intercorporate agreements under transfer pricing. Then you draft your transfer pricing policies, which are in line with your intercorporate agreements and benchmarking studies. TP policies is something, it's like the way you do business globally. When you answer this particular sentence, it's basically drafting a policy. Or maybe if you want to say how your entire enterprise is looking at financing globally. So then you draft an intercorporate financing policy. But that's only possible when you undertake your benchmark studies, identify parties, look at transactions, who is going to fund whom, enter into intercorporate agreements, and then you draft your policies. Once you do that, it's all about implementation. And once you implement, you need to monitor. So monitor your global profits, monitor your supply chains, monitor the way how every profit center is making profit and the prices are moving. That is after your year end or during your year end. After your year end, then you document it the way it is shown, or maybe as per the documentation regulations of a particular country and UAE. And last but not the least, it's representations to tax authorities and proving your arm's length nature before the tax authorities. A quick journey, the way how a transfer pricing jigsaw works. We start with the functional analysis. Functional analysis is knowing more about the company, it's knowing more about the industry. The idea is to ultimately facilitate comparability and a third party comparison. To do that, we need to characterize a particular entity in your group. So if you are looking at undertaking transfer pricing on a UAE distribution entity, I'm assuming it is a distribution entity, but I need to first characterize it into a distribution entity. Once you characterize it into a distribution entity, then we have to find out other distribution entities to compare this distribution entity into. And for that, we need a tested party to compare. So tested party is a party on which the entire transfer pricing analysis is undertaken. After you identify a tested party and you characterize the model, then you look at various methods that you want to apply, and then you conclude whether you're at arm's length or not. So this is typically a transfer pricing journey for any transaction that is undertaken between two related parties. So if there are 10 transactions, when I say transaction, it means group of transactions. Sale of products, provision of service, you can say sale of fixed assets, licensing of an intangible property. These are separate transactions in itself. And ultimately, every transaction needs to move towards a conclusion whether the transaction is at arm's length or is it not at arm's length.
I think we can go ahead now to the, after this slide, maybe we can go to the CT because we have like only 10 more minutes.
Okay, sure. These are quick pillars of transfer pricing here, which talks of design, which is what we just discussed. Document is the transfer pricing study report and the 3-tier documentation that we have to look into, and ultimately the defense mechanism, which is the interaction with the TP authorities. So this is a little bit about function analysis. Ashna, I'll just quickly cover methods for the group. So 6 methods in all. The first 3 are called as the traditional methods, and typically the first method focuses a lot on price, whereas the second and third method focuses a lot on gross profit margins, and the fourth and fifth method focuses a lot on net profit margins. 80% of the time, the fourth method, which is a transactional net margin method, is used, for which there are databases where you undertake searches and a comparability analysis is undertaken. This is a quick hierarchy of transfer pricing method, the way it is used as compared to functional comparability and a product comparability. 2 approaches we just discussed on price setting and price testing. Few applicabilities. Ashna, this is an important slide just for the benefit, because I get a lot of questions around the databases to be used by say UAE based companies.
Yeah.
And there are various global databases available. There is no one database which is prescribed by government. So for general TNMM searches, there could be Thomson Reuters, one source as a database, or one can use a BVD database. Generally, they give very similar outputs because they are collating database. They are collating data from similar sources. From an India perspective, there are 3 databases: Provus, Capital, and HTP. But UAE as a jurisdiction has prescribed a region-based documentation, and hence a region-based comparability analysis could be undertaken. Then for other transactions like royalties and interest, you have either royalty range, KT mine, or royalty source. And even for service transactions on a per service basis, you can look at royalty range or other databases to look at per man hour as an important factor to find. So this is about documentation. Thresholds level are prescribed, which we just discussed. 3 levels: master file, local file, and country by country reporting. And few examples of transactions which one should be looking into. I'll leave back this PPT with all of you. Yeah. Krishna, over to you on the small business relief.
Small business relief, in this definition, it's very important to understand 2 things here. First of all, your tax period. What is your tax period? Any tax period with your financial year can be Jan to December, or June to May, or October to, it's up to each company that they choose their financial year. But anything which is after 1st of June 23 and up to 31st December 26, it is going to fall within that bracket. So they have given a particular time frame to opt this small business relief. Beyond that, as of now, whether it will extend or not, nobody knows. But to opt for a small business relief, you have to understand that your revenue for that period, tax period, should be less than 3 million. So for any taxable person whose revenue is less than 3 million in the tax period can opt for this relief. But once you opt for this relief, there are certain things that you lose. Like you cannot claim all the deductions. If you have a tax loss that cannot be carried forward. Yes, for TP documentation, you don't have to follow the TP documentation. That is ideally the master file, local file. But that does not mean that you are not going to comply with the general accounting provisions or the transaction which you're doing to related party, connected party. These have to be ideally followed as per the TP overall OECD guideline laws only, but TP documentation don't have to be maintained. There's another condition to it. If a small business should be one which is not a part of an M&E group. If you are already a part of a multinational group, then you don't come under this small business relief. You're not eligible for a small business relief. So before understanding, first, you have to understand your tax period. And secondly, you have to understand what is your turnover. And then weigh your options whether the small business relief is actually beneficial for you or not. Next slide. So again, what are the limitations? You won't be able to carry forward the losses. Interest, you can claim up to 30%, but once you opt for the small business relief, you will lose this interest benefit of carry forward of interest, deduction of interest. But most important here is to understand, suppose there is a business who's earning 6 million turnover, and now it has, seeing this condition, they have split their business. Say one company is formed in mainland and another one is formed in the free zone. So they have split their turnover just to take the benefit of this relief. Then they may lose it considering the GAR law. You have to understand here that this should not be like a part of your tax planning or tax avoidance ideally. So the company who's earning revenue which is less than 3 million can opt for it, but you can't plan considering keeping in mind the GAR provisions. Artificially, you can't separate your business. Next slide. Resident and non-resident. There's a recent provision which is come relevant to Cabinet Decision 49 for a resident and a non-resident. If your turnover which is derived from a business or business activity which exceeds 1 million, within the, it does not exceed 1 million, then you can opt for this. But what is natural person? If you're a natural person and if you are earning revenue out of this 3 criteria which they have mentioned, then you don't have to register for CT. 3 of the criteria, one is wages, one is personal investment income, and one is real estate investment income. If you are deriving purely revenue from this, which does not exceed 1 million dirhams within the calendar year, then you may not opt for registering on the corporate tax regime. But again, here it is very important to understand what kind of activity you're doing. Does this come under the definition of business activity or not? Are you doing it in the nature of business or not? Most of the time people ask me, like, I have 10 properties and I'm getting rental income. What will happen to this kind of income? So the thing is here is you have to understand whether you are doing it as a part of an activity or you have invested out of your profits or out of your salary and then bought these real estate properties and you're earning rental on it. There are individuals who have hired third party to manage those properties. Then ideally you are doing a business out of this real estate and you will need to come under the purview of CT. So there is a very thin line and a thin margin here. The last one which we want to take up for the day is Cabinet Decision 114. What kind of accounting standards and methods one needs to follow? Previously, we all know that there was no compulsion on accounting. VAT was also there, but people were using Excels to file VAT data. But now with CT coming in, they have lined up what kind of accounts you need to maintain. So ideally, it should consist of your statement of income, the balance sheet, comprehensive income statement, and statement of changes and equity of cash flow statement. They're also allowing you to maintain books on cash basis of accounting. Ideally, it is not very encouraging to maintain books on cash basis of accounting because reconciliation can become a task. If you are filing VAT on, say, invoices on due basis, accrued basis, and if you file your CT on cash receipt basis, there is going to be a lot of confusion within your company itself, maintaining books as per VAT for the CT law. So ideally, cash basis of accounting is not what we encourage. But yes, they have allowed companies whose revenue does not exceed 3 million can opt for cash basis of accounting. Overall, in UAE, IFRS is what is going to be followed. But if your turnover is going to be less than 50 million, you can opt for IFRS for SMEs also. So this is what is our presentation for the day. There are a lot of other clarifications which are still awaited in the next 2 days. And there are a few others which have also been released, but we'll need another session to cover up that, like participating interest is there, transitional provisions have come in, but that itself will take an hour because there are long updates which have come. So I would say we'll have another session with Simran and then go through all of them.
Yes, definitely. I think with this, we have come towards the end of the presentation. However, before we move on to the Q&A session, we would love to hear everyone's feedback. So I will just quickly launch a short poll if everyone could respond on the feedback of the session. Meanwhile, CA Ashna and CA Akshay, you can go through the Q&A that have been posted in the Q&A panel and see what kind of questions would you like to answer or take up live.
The first one they said is, can you please share the presentation material of your first webinar on? I think Simran has it, right? The one which we had done some months back, I think.
Yeah, I'll have to look into that and we'll share.
Okay. Do entities registered in BVI but managed from UAE fall under the home criteria for CT purposes?
POEM is not a simple concept. It needs a very, very detailed scrutiny to answer this particular question because there needs to be POEM guidelines too. However, if I have to just respond to this email, considering it is fully managed from UAE, ideally, yes, it has the potential to become POEM in the UAE for city purposes. But yes, a detailed evaluation is needed, but yes, it has very high potential.
Yeah, but ideally, if it's an offshore company and it's going to be managed from UAE, then it is going to be considered as UAE sourced income because BVI doesn't have tax. So yes, again, study has to be done, but just going by the simplicity of the question, like sending the transaction, if it's a BVI registered company, but fully managed from, because the agent is from UAE. Every BVI company needs an agent and the agent has registered office here. So if you just go by that question, then yes, it will ideally come under the city law here.
Yeah.
What about mandatory of audit report?
But ideally, Ashna, maybe there could be a potential.
Sorry,
some technical issues. some technical issue. No, there could be potential restructuring opportunities around here if there is a because with this law coming in, POEM has to be looked at too, and one may like to then restructure their transactions rather than pulling all the income into UAE as a resident, because then you become a resident in UAE.
Yes, true. What about mandatory of audit report for medium-sized company who are not reaching profit? Yeah, audit, if you opt for the small business relief, then yes, you will not have to do audit. But again, all the free zones are asking for audit report. So ideally, the company should get their books audited. Even for qualifying free zone, if you opt, how would you justify the ministry that you are compliant with all the provisions and you are a qualifying free zone? This can happen only when you do your audits. Otherwise, it is not going to be justified, is what we feel. But yes, they haven't, if you offer the relief, you don't have to maintain the audit report. But as of now, most of the free zones are asking. So audit report, I don't think should be avoided. It should be, the company should willingly do audits to keep themselves compliant. What are the expenses not agreed for tax calculation? As of now, the expenses part, what we are seeing for tax calculation is expenses which are not business related expenses cannot be taken as a deduction, like fines, penalties, or any expenses which does not help you in deriving or generating the revenue of the company is not going to be an allowed expense, which generally is there for every other tax jurisdiction. It's like that only. So like entertainment expenses has a cap of 50%, interest has a cap of 40%. Other than that, I don't see any expense which will specifically be disallowed. If it is not related to business, yes, it is going to be like, I'm not sure if they say I want to pay my staff house rent through the company just to, increase the expenses of the company. These kind of expenses will not be allowed. But if it's it is any expense which helps in generating the revenue and it is incurred because of generating revenue, yes, it will be allowed. Will it imply to trading houses?
Will it apply? So will it, I'm assuming it is whether transfer pricing would apply to trading houses who does third party trade, no physical existence in Dubai. Part of question, if it is fully third parties, transfer pricing doesn't apply. However, if there is a possibility of a significant influence on the third party, then only it can be considered as a related party and then transfer pricing would apply. But if there is no related party included here, there is no possibility of transfer pricing coming in. Next is for Simran, need to have a recorded webinar. Okay. Okay, the next one is you have mentioned minimum 50% shareholding for related parties. While as in GCC, there is a 49% shareholding limit. Does the related party rule will still apply? So it actually says 50% plus, 50 or 50% plus. So ideally, if it is 49%, it will not be considered as a related party as per the law if there is no other significant influence between these two enterprises.
But again, what happens is, I think he's referring to that 51-49% setup where the sponsor is only taken for record purposes, but the main person, controlling person behind is that 49% owner. So when he can influence the decision, then again, TP law will have to be complied with.
But he's a separate shareholder. And suppose this separate shareholder is also a shareholder of 49% in other companies. And if it doesn't have a significant influence, barring that, then no TP applies. But if he has a significant influence, then of course, as you said, transfer pricing would apply.
Will apply. Significant influence will matter here because generally 49% is taken for record purposes. Mainland company have 100% subsidiary in another emirate. In mainland, have separate
can have transaction on cost price and they have 0%. So ideally, a mainland will be taxable at 9% in any Emirates. and there will not be any arbitrage. So I don't think there is any transfer pricing required in the same country because it is one country. And if you are having the same rates, uh, I think the new cabinet decision is also very clear that until unless there is rate arbitrage, TP documentation is not expected to be maintained by two domestic companies.
Yeah.
We are paying the resident rent of employees. Can we put it as expenses?
Yeah, again, this if it is like a company policy within the policy rules of the company that they're paying it for everybody, it's a common policy which you are adopting within the, like some companies they give tuition fee, students tuition fee for their employees, or insurance is given as a higher slab. These are within the policy of the company is fine, but if you are specifically giving it to one person, do you have to study this transaction? If it was all the employees, I don't see a challenge there in claiming as an expense. But if it is not a part of the policy and it is given for one particular manager or management to seeing the effect on the net profit, then may not be allowed. But otherwise, I don't see a challenge here if it is a part of a policy. What do you feel, Akshay?
So I feel policies could also be made for one person if that position is very special. So if there is for a director and there is a policy for a director for rents, is absolutely fine. However, a residential rent, one also needs to prove that that residence is also used as office. Otherwise, there could be n number of personal expenditure of an employee that could be borne by a company. Because we always need to remember that UAE as a jurisdiction, it doesn't have personal income taxes. So there is high possibility of undertaking personal expenditure from business. So
Yes.
if this is a personal expenditure on business, ideally it will not be allowed. And Ashna, as you rightly said, there has to be a policy, there has to be certain business logic. I think it's all about substance and commercial substance. If that employee is IT driven employee working from home, then no problem in providing rent for that. So again, policy documentation is very essential for it.
My personal money invested in a company as investor and not as a partner.
So this investment income as aggregate profit share is taxable, is the question.
Yeah, again, we have to see the amount, right? Here, what is the amount? What are the revenue you are earning from this investment is what you need to understand. Just because you have invested somewhere, but what are you getting profit share? Are you getting dividend? Are you getting royalty? Is what you will need to understand here. And what is the bracket? What is the amount that you are generating out of it? Because just at a personal level, if you have invested in a business, it is not, and it is one-off. Then depending upon the profit share that you're getting, and if you're not a partner, I understand in UAE there are a lot of people who are not partners on record, but it is important to understand that's why they've said investment income is not in there for natural person, but investment income, again, what is the level of investment you have done and what are the nature of money that you will generate, revenue will generate out of this investment is important to study. Can we please have a presentation copy that is for Simran? Can me the link of this session at. Okay. Is TP applicable to two companies inside onshore or between two different tax like mainland and free zone?
From a UAE perspective, to apply a domestic TP, there has to be a tax arbitrage. So it has to be a qualified free zone and mainland. If there are two mainland companies, ideally TP doesn't apply. Otherwise, transfer pricing applies when there are two countries. Like if you have India and UAE, if you have UK and UAE, then transfer pricing would apply. And both, then you need related parties and all those other international transactions as a condition to fulfill. Also for tourism agency, what is the transfer price? The answer to transfer pricing is not so simple, and industries have different challenges. So it depends on the way how any tourism agency is spread out and what type of operation it has. So of course, it will be on a case-to-case basis, but there are industry-wide aspects that we need to consider.
Thanks for
Rajesh.
when we need to register. There is no deadline as such, and in the first webinar, first session, physical session with ministry I attended it, they were very specifically said that they won't penalize companies for not registering because the law itself is not fully released yet. And every company has 9 months after the tax period is over to do the filing of the CT. So there is ample time for a company to register. It's not that you have to register. You can register after your first tax period. You have 9 months of time. So as of now, there is no deadline for registration. But again, I do not see a challenge why a company should not register. It is not like VAT. In the VAT, pre-VAT era, there was a confusion. People registered and then they didn't understand why they registered. But that is not the question of CT. Corporate tax is applicable for everybody. So registration will be mandatory. Yeah, time frame is not given as yet. Many group entities are doing stock transfer with no particular policy. Impact is huge if it is pointed out by FTA. What immediate remedy before the TP study?
So this is the design part that I was talking about. The 3Ds, the design, document, and defend. Design is the entire planning of transfer pricing structure and your transactions. So if there are stock transfers which are happening till date, this cannot happen after the transfer pricing legislation comes in. So we need to find out, first of all, this stock transfer needs to be between one company in mainland and another company in qualified free zone, or one company in free zone or mainland with a company outside of UAE. So in such a case, we need to devise a transfer pricing policy, go through all those 6 steps that I discussed about before the transfer pricing study, and monitor those transactions on a continuous basis.
I have an audit Jan to December when I have to register. Again, I understand from Jan to December will be Jan 24 to December 24. So you have time till September 25 to file your corporate tax return. So ideally, even after the year end, you can do your corporate tax registration. That is in 2025, even before you file the CT. They haven't given a deadline as of now. Next is we can opt the financial period as currently we are following the Gregorian calendar as a. Yes, you can opt, but to opt for a tax period, you have to understand why you are breaking from your Gregorian calendar year period. You can opt for a different tax period, like if you are a part of a company who follows a different tax period, you want to align your financial year with your head office, then yes, you can break the year. But you have to have proper reasons why you're breaking. Plus, you have to align all your other documents like your MOA, your audit reports you have done previously. So this is the time you need to plan for it and then opt for another year. There is no harm in opting, but you need to justify why you're doing it. I have DMCC free zone company. Okay. Okay, for the I think it was in the previous question. I have audit Jan to December. I have a DMCC free zone. Yes, that's fine. It may be anywhere. So the deadline is not come for registration. What the model I can follow?
I think this is for the travel agency.
Yeah.
It will be basically a service fee model, but it all depends on the business that you're undertaking. So very much case to case basis. Happy to take this offline. The next question is very interesting. How to determine the management fee for cross services that are provided to subsidiary. Now I can go on for 2 hours on this. Lot of work done already on management fees. Now ideally this topic is covered extensively by OECD transfer pricing guidelines in their chapter called as intragroup services. Now, when you are actually providing management fee, there are certain series of, you can say, steps that you need to consider. The first step is, first of all, proving to the tax authorities that the service indeed is been rendered. Because unlike transfer of goods, when you're providing any management services, you cannot see those management services. They are very intangible in nature. So all type of documentation around the services that you have provided needs to be documented and proven to the tax authorities that indeed a service has been provided. Point number two, we need to see whether what type of method to follow in transfer pricing. First of all, of allocation. Your allocation method could be direct, it could be indirect, or it could combining both of these. And third is the valuation aspect. I'm just trying to summarize it, but quite a lot detailed studies on these. On the valuation aspect, we need to see what type of margins other comparable companies who are into business support services are making, which are in strategic business support service. If you are really doing a management type of a service, and then you add on this particular percentage of profitability onto the cost, and ideally in such a scenario, cost plus method is followed for setting, and transactional net margin method is followed for testing. So it's a science in itself, but happy to take it offline. But this is what your OECD guidelines say, and that will be consistent with the UAE transfer pricing regulations too.
Employee benefits like bonuses, incentives. Yes, if it's in the policy, then and it is encouraging the business growth. Incentives and bonuses are definitely linked to the targets of the business. If they are linked to the targets of the business, then yes. I don't see other bonuses here, but this is, yes, it can be taken as an expense. Recorded webinar, yes, Simran can do that, I think. We have prepared the opening balance sheet first time. Should we certify it from the auditors? It is definitely encouraging. If being an auditor, I wouldn't say don't certify it from an auditor, but it also gives you a kickstart. If you have done it for the first time, yes, you should get it certified from an auditor. So you know that you have followed all the transitional provision rule which they are mentioning. Then you don't have to worry, and it becomes the auditor's responsibility that is touch based all the aspects of the CT law for you to begin your books of accounts. So I would definitely put a yes there. We are free zone company having customer in mainland. We are raising sales invoices from mainland. So if you are a free zone company, how are you raising mainland? For mainland, okay, customers. For further goods will be transferred to third party within the free zone only. Yeah, again, this we have to understand the yet what is going to be qualifying free zone and how the substance will be formed. Just because you have a company in free zone and you are transacting with mainland, you may be breaking the free zone rules. So as of now, you will, and it will not come under the qualifying income definition. So you will come under 9% is what we feel as of now, unless there are further updates on qualifying income.
Just to extend that, because the transaction is being done with a free zone again, which is a third party free zone, transfer pricing would not apply.
Yeah. For two mainland related parties, is the fair value arm's length?
If you are enjoying the same amount,
same jurisdiction, right? Same jurisdiction.
Yeah, it doesn't apply.
In knowledge village. Someone is tuition class in knowledge village. Yes, again, you come under the individual category here, natural person earning revenue. But again, you have to see what is the amount of revenue that you are earning. If it's less than the threshold of 1 million, then you don't have to register. But you have to understand what is the amount here. Mainland company has a branch in free zone premises. Does that branch in free zone is qualifying or non-qualifying? Branch is a part of the main, it will be clubbed in the books. As such, branch will not have a separate identity of its own. It is going to be clubbed along with the license, the main license, the main company under which the branch is formed. So only branch will not have its own identity for city purposes. It is particular such cases of the services we provide to be the TP in our case, like golfing and hotel, for example.
I think, Jean, we will have to definitely look more in the facts of your exact industry and business. Happy to connect with you offline in terms of understanding what the TP needs are for the tourism industry for sure. We'll be happy to answer.
Any limit for partners, directors, entertainment expenses, house rent, and other withdrawals? Again, entertainment expense as such is 50%, but it depends upon what nature of entertainment expense it is. But as of now, entertainment is taken as 50%, and that expense should be related to business. So because of the business, they're doing that. It should not like you take clients out for dinner or these are considered under entertainment expense. Its cap is 50% as of now. I think with this we have answered all the questions. Simran, over to you.
Yes.
Oh,
Thank you so much. I'm sure after such a healthy discussion, we have been
There are
able
more
to
just
offer
popped in.
great clarity, but we can take them offline.
True.
I think the questions will never end. So there are some questions that do remain unanswered, but you can definitely reach out to us, or you can reach out to CA Akshay or CA Ashna on their LinkedIn's too. We also aim to host many more such sessions in the coming days and weeks, and we request you all to stay tuned and register for all the upcoming sessions. I would like to thank the speakers, CA Ashna and CA Akshay, for accepting our invite and delivering such an insightful session. A big thanks to each one of you for accepting our invitation and taking out your valuable time to attend this webinar. We appreciate you all being here. Have a wonderful week ahead. Thank you. Thank you so much.
Thank you. Thank you,
Thank you, Simran. Thank you for organizing this.
Thank you.